The market tends to focus on the investment bank. We're very pleased with the results there, 13% up year on year. Our FIC business and also within that, the financing business doing very well. Origination advisory for the corporate finance products for us also quite well at 54% up year on year. So we see very strong momentum and client engagement there. We're also seeing resilience and growth across the other three businesses. Mm-hmm. So it's nice to have a shining star, but seeing resilience on the more balance sheet sensitive businesses of our corporate bank and private bank is encouraging, and there's also fee and commission income growth there. And assets under management and revenues in our asset management business also growing strongly. So we're encouraged by the momentum we're seeing across the businesses.
And casting us a little bit into the future, or I should say the recent past in April, what have you seen in terms of fees and trading there?
Look, I think the trends from Q1 have continued into April. In our fixed income and currencies businesses, that would really be a slower macro environment. Volatility has been relatively low. But continued momentum in credit trading and emerging markets. And so that's been an okay mix for us. We do think that the recovery in the wallet in corporate finance will continue across the year. Q1 was obviously very strong in debt products, so investment grade and a recovery in non-investment grade. We do expect that to continue and hopefully see a further recovery in M&A and equity activity.
And so you take us to M&A and IPOs and the animal spirits within Europe. Obviously, we have the rate story sort of percolating here. Are the animal spirits back in Europe? Last time we spoke, you're very optimistic on M&A. Has that come through?
They're coming back, yeah. If you look at announced volume in the first quarter, that has recovered. Obviously, the fee revenue that generates is always delayed, but that trend is there. To be fair, it's been more reticent than I would have expected, especially with equity markets sort of at all-time highs. So I think there's a degree of uncertainty still out there, as you mentioned, path of rates and geopolitical uncertainties. So there are some things still holding the animal spirits back a little bit, but the momentum is there.
And before we get to rates, I want to talk quickly about just trading. Given how you've outperformed in FIC, particularly versus the U.S. peers, are you looking to build that business out further, perhaps doing more on U.S. rates?
We've been investing steadily over the years, so no dramatic change, but I think a continued targeted investment. Ram Nayak and his team have been very deliberate in just filling in gaps that we have. We've talked about flow credit, for example, where we've made investments around the globe, and that is showing through. We have and continue to invest, as you say, in U.S. rates, and we've built our business there. So it's been filling in, if you like, the white or whiter spaces, and we're very encouraged by the platform we now have. Not just people, but also technology and connectivity with clients.
And in terms of the ECB, what are you expecting from the ECB this year? And I'm trying to get a sense of how that works itself through the business. We saw a little bit of weakness, a little misses on the private bank, the commercial bank, IB outperforming. Is that the story now? Net interest income dead? We're going to...
Well, no. I mean, so there was certainly and we talked about this with investors on the 1st of February, a year-on-year decline in net interest income. Yeah. Absolutely, we called for. And we're seeing that pressure, roll through those businesses. Interestingly, the performance there is better than we'd anticipated. Mm-hmm. And so deposit, particularly in the private bank, by the way, and here in Germany, deposit margins have held up better than we thought. There's been some volatility in sort of what I'll call non-repeating elements of non-interest income, but the underlying performance has been quite stable in the banking book business at about 3.3 billion of revenues on a quarterly basis. And so the path that we think we'll now walk from here is a little bit further down in Q2, and then a recovery in the back half of the year in interest income in those two businesses.
And so what are you expecting from the ECB? Do you feel that inflation is under control in Europe?
We would align with the market sentiment that June is the beginning of the sort of cutting rate cycle. Europe has been, if not in recession, in a much slower growth mode. I think the transmission mechanisms vary across the countries here, but have been felt in the economy of interest rates. And so, we think that cyclical sort of point has been reached, and which is actually encouraging for growth as I look to the back half of this year and into 25. And as you've seen more recently, and some of the numbers in Germany have started to increase as well, manufacturing activity and what have you. So that seems like an encouraging outlook to us.
So when you speak to clients, what's driving their decisions right now? Is it the fact that we get that first cut in June? Is it the fact that we're actually going to get fewer cuts than anticipated? Or is it the Fed?
I think it's the general outlook for the global economy. So our clients, especially corporate clients, manufacturers, are looking at growth in their sales markets and how they're positioned to meet demand. One indicator for us is going to be loan growth, which has also been slower to start to build than we'd anticipated. We've been running flat essentially the past couple of quarters, and have been anticipating some increase in demand. Now, there's a variety of factors at work there as well, but we do think that momentum is there and will begin to make itself felt. Do interest rates play a role? Sure, they play a role, but I think the general outlook and confidence in the economic direction is more powerful.
And you think that there's going to be a catalyst for growth in Europe in the back half of the year? Because I think a lot of people are very reticent to give that forecast.
I think the catalyst, the general environment and catalysts are there. Again, a move away from interest rates, although a declining interest rate environment will be supportive of growth. I think just as you go through the back end of a cycle, I mean, take real estate as an example, and the construction trades here in Germany, that's been through really a 2-year decline, and eventually it finds a floor and a point from which developers and builders find confidence with the prices in the real estate market find a floor, and we grow from there.